Bangkok, July 2nd, 1997. On trading screens around the world, one number began to move, and it was not supposed to move. For years, the Thai baht had been held close to the US dollar. To investors, that stability looked almost guaranteed. Then, the guarantee broke. By the end of the day, the baht had dropped sharply. What looked like a local currency problem was about to become something much larger. Most people in New York, London, and Frankfurt barely noticed at first. A small Asian currency, a faraway market, a regional problem. They were wrong. In the months that followed, currencies collapsed, stock markets bled, banks closed, and companies failed. In Indonesia, an economic shock collided with a political crisis powerful enough to bring down a regime. But the deeper shock was not just financial, it was philosophical. The crisis forced Asia, and eventually the world, to ask a question that still matters today. What happens when cheap foreign money, fixed exchange rates, dollar debt, and blind confidence all meet at the same time? The answer began in Thailand. For most of the 1990s, East and Southeast Asia looked like the future. Thailand, Malaysia, Indonesia, South Korea, and the Philippines were growing fast. Some had been poor only a generation earlier. Now they had highways, export zones, rising factories, new airports, and skylines full of cranes. The World Bank had already called the region's earlier success the East Asian miracle. And from the outside, the story was irresistible. Young workforces, high savings, export machines. Governments that seemed to understand development better than many Western experts had expected. This was not fake growth. Much of it was real. Korean conglomerates were selling cars and electronics around the world. Thai and Malaysian cities were filling with offices, malls, and hotels. Foreign investors saw Asia not as a risk, but as an opportunity they could not afford to miss. So money poured in. Foreign banks lent aggressively. Fund managers bought stocks and bonds. Local banks borrowed abroad and lent at home. Developers built towers. Companies expanded. Asset prices rose. Confidence became its own form of fuel. But underneath the miracle, a quieter machine had been built, and that machine depended on one fragile assumption, that foreign capital would always keep flowing in. To understand what broke in 1997, do not begin with panic. Begin with the machine. First, exchange rates that looked stable. Many Asian currencies were fixed, semi-fixed, or quietly managed against the US dollar. To investors, this made the region feel safer than it really was. Second, borrowing in dollars. Local banks and companies could often borrow more cheaply in US dollars than in their own currencies. Third, short-term debt. A lot of this money had to be rolled over again and again. The system worked only as long as foreign lenders stayed calm. Fourth, asset bubbles. Cheap credit flowed into property, stocks, and corporate expansion. Towers went up. Balance sheets stretched. Prices rose because everyone believed prices would keep rising. Fifth, weak supervision. Financial systems had grown faster than the regulators watching them. Some banks lent too freely, some companies borrowed too much. Political relationships sometimes hid bad loans behind clean-looking balance sheets. The simple version is this. Imagine earning your salary in local currency, but owing your mortgage in dollars. As long as the exchange rate holds, life feels normal. But if your currency falls, your debt explodes overnight. Now multiply that household by banks, developers, factories, and governments across a region. That was the hidden machine. Thailand was where it cracked first. By 1996, exports were slowing. The current account deficit was wide. Bangkok's property boom was losing air. Finance companies that had once looked aggressive began to look fragile. Then traders began testing the baht. The Bank of Thailand defended the currency, but the defense was more complicated than the headline reserve numbers suggested. Much of the fight had moved into forward market commitments. On paper, the central bank still had reserves. In practice, its room to defend the baht was running out. This is the moment when a financial system becomes a confidence game. If everyone believes the peg will hold, it can hold. But once investors believe the central bank may not have enough ammunition, the attack feeds itself. On July 2nd, 1997, Thailand let the baht float. The peg was gone. It is tempting to tell this story as a duel between heroic governments and villainous speculators. George Soros became the famous face of that narrative in parts of Asia, but that version is too simple. Speculators did not create Thailand's bad loans. They did not build the empty towers. They did not design the currency regime. They saw a structure that was already cracked, and they leaned on the crack until it broke. The baht was the first domino, not the last. After Thailand, investors ask the question that turns a crisis into contagion. Who else looks like this? Who else has dollar debt? Who else depends on foreign capital staying calm? Who else has a currency that might not survive pressure? The answer was uncomfortable. A lot of people. The Philippine peso came under pressure, the Malaysian ringgit followed, the Indonesian rupiah entered one of the worst collapses of the crisis. By late 1997, the panic reached South Korea. One of Asia's great industrial success stories, South Korea did not look like Thailand. It had world-class companies and global exporters, but its banks and conglomerates depended heavily on short-term foreign borrowing. When foreign lenders stopped rolling over that debt, strength turned into vulnerability. That is what financial contagion really means. It does not mean every country has the same problem. It means fear stops being specific. Investors no longer ask, "Is Thailand weak?" They ask, "Who else might be Thailand?" And once that question spreads, money does not walk out. It runs. Behind the charts were people. Across the region, currencies plunged. Dollar debts became heavier in local currency terms. Companies that had looked profitable under one exchange rate suddenly looked bankrupt under another. Banks froze lending, construction stopped, imported goods became more expensive, workers lost jobs, small businesses closed, families who had planned for a bigger apartment, a new shop, or a child's education suddenly planned only for the next month. In Indonesia, the economic collapse fed into a wider political crisis. Prices rose, anger spread, confidence in the old order broke. In May 1998, President Suharto resigned after more than 3 decades in power. This is what a currency crisis looks like at street level. It begins with exchange rates, then it becomes unemployment, then it becomes politics. Into this wreckage walked the International Monetary Fund. The rescue packages were huge, but the numbers need to be read carefully. Thailand received an IMF standby credit of about $3.9 billion inside a broader financing package of roughly $17.2 billion. Indonesia received an IMF standby credit of about $10.1 billion. South Korea received an IMF standby credit of about $21 billion, while the wider rescue package, including the World Bank, the Asian Development Bank, and bilateral support, reached roughly $58 billion. The money came with conditions: higher interest rates, tighter budgets, closure or restructuring of weak financial institutions, new rules for banks, corporations, and foreign investors. Supporters argued this was the only way to restore confidence. Critics argued the medicine was too harsh. High rates could crush companies. Sudden bank closures could deepen panic, and emergency reforms could feel less like rescue than surrender. The truth is not simple. The IMF helped stop collapse. It also left a memory. Across Asia, 1997 became a warning. When a country runs out of dollars, the terms of rescue may be written somewhere else. South Korea became the most dramatic example of crisis and recovery. In late 1997, Seoul went from confident industrial powerhouse to emergency borrower in a matter of weeks. The period is still remembered in South Korea simply as the IMF crisis. Then came one of the most emotional moments of the entire story. In early 1998, millions of South Koreans joined a national gold collection campaign. People brought wedding rings, heirlooms, baby gifts, and family keepsakes to banks. Korean sources commonly report that about 3.5 million people participated and roughly 227 tons of gold were collected. Economically, the gold did not solve the crisis by itself. Symbolically, it turned a balance of payments crisis into a national memory. Korea experienced humiliation, sacrifice, restructuring, and recovery all at once. In the years that followed, banks were reformed. Some chaebol collapsed. and corporate governance slowly opened. Korea became more disciplined, more export-focused, and more determined never to be trapped the same way again. Malaysia took a different road. In September 1998, Prime Minister Mahathir Mohamad imposed capital controls. The government restricted offshore trading of the ringgit, limited some portfolio outflows, and fixed the ringgit at 3.80 to the US dollar. This was not what Washington wanted to hear. For years, the dominant idea had been that capital should move freely. Malaysia challenged that logic. Decades later, the verdict is still debated. Some economists argue Malaysia's controls helped stabilize the economy. Others argue the recovery would have happened anyway, and that the controls may have protected politically connected firms. But the lesson was bigger than Malaysia. It was not that capital controls were always good. It was that in a panic, the old certainty that money must always be free to leave was no longer untouchable. This is where the crisis stops being history and starts touching the world we live in now. After 1997, many Asian governments drew one brutal lesson: never run out of dollars again. Central banks began building larger foreign exchange reserves. Reserves became more than accounting entries. They became shields. Asian economies became more cautious about foreign borrowing. They watched short-term dollar debt with new suspicion. They encouraged deeper local bond markets. They built regional safety nets and currency swap arrangements. The crisis also changed how Asia viewed the IMF. The institution still mattered, but the memory of 1997 made many governments determined not to depend entirely on IMF rescue packages again. Then came another layer. In the 2000s, economists began debating the global saving glut, the idea that excess savings from parts of the world, including post-crisis Asia, flowed into U.S. safe assets and helped push down long-term interest rates. That did not cause the 2008 crisis by itself, but it became one of the background forces behind the financial world that produced it. So when Western viewers ask why a crisis in Thailand should matter to them, the answer is simple. Because the shock did not stay in Thailand. It changed how Asia saves, how America borrows, how emerging markets fear dollar debt, how governments think about reserves, how crises are rescued, and how global capitalism protects itself from the next panic. In the end, the Asian financial crisis was not simply an Asian failure. It was a stress test that the global system happened to fail in one region first: cheap foreign money, fixed exchange rates, weak supervision, short-term dollar debt, borrowers who believed the music would never stop, lenders who believed someone else was watching. When those forces meet, it does not matter whether the address is Bangkok, Seoul, Reykjavik, or Wall Street. The crack always starts somewhere quiet. Then it travels. 1997 was the warning. The world heard parts of it. It is still arguing today about the parts it tried to forget. This has been ASIA Business Noir, where the numbers are cold, but the story is always human.